Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Monday, 15th September. Coming up on the show, markets are poised for a Fed rate cut this week. But just how many more will there be in 2025? Nvidia shares slide in the pre-market after China says the chip giant violated anti-monopoly law. And is it a case of the Labubu doldrums? Has the once popular trend started to fizzle out? So grab your coffee and let's own the morning. Well, overnight, China has ruled that Nvidia violated anti-monopoly laws after concluding an initial investigation. This is likely to ramp up the pressure on Washington during sensitive trade negotiations that are taking place right now in Madrid. Nvidia shares fell over 2% in the pre-market. The company has previously disclosed it's facing scrutiny inside China, where regulators demanded it keep supplying local companies in return for regulatory approval of its 2020 acquisition of Mellanox. According to China's antitrust law, companies can face fines of between 1 and 10% of their annual sales from the previous year. China generated $17 billion in revenue for Nvidia in the fiscal year ending January 26, or 13% of total sales, based on its last annual report. Now, US-China trade talks continue in Madrid today with the sale of TikTok high up on the agenda. Here's President Trump's take on that. He was speaking before China released its Nvidia statement.
I may or may not. They're negotiating TikTok right now. We may let it die, or we may, I don't know, it depends, up to China. It doesn't matter too much. I'd like to do it for the kids, they like it. I mean, selfishly speaking, I did very well on TikTok, and I got the youth vote. I got numbers that nobody's ever even come close to in the Republican Party, nobody. If you look back to Romney and all these people, they got practically no votes. I got a lot. And some was attributed to TikTok, and a lot was attributed to Charlie.
Well, the first thing you need to know about is the world's second largest economy, China. Economic activity in the country slowed more than expected across the board in August. This has added to the likelihood that Beijing will roll out more stimulus in order to hit its official growth targets. Industrial output and consumption had their worst month yet this year, after a sharp slowdown in July, an underperformance that may heap more pressure on Chinese negotiators during high-level trade talks this week with US representatives. With a boom in exports cooling off, many analysts are predicting a downshift in China's economy during the final months of 2025. The next thing you need to know about is changes to the Federal Reserve Board. The Senate will vote tonight on Stephen Miron's nomination to the Federal Reserve's Board of Governors. The timing is significant. If all the formal steps align, Miron could have a say in this week's Fed meeting. Whether he can be sworn in quickly enough to participate, though, still remains unclear. Meanwhile, the Trump administration is also racing to sideline Fed Reserve Governor Lisa Cook before this week's policy meeting and has asked a federal appeals court to pause a lower court order that restored her to the central bank's board. And the final thing to know is that the Federal Reserve is widely expected to make its first rate cut in 2025 this week. The bigger question for investors is how many more cuts could be on the way as the central bank contends with a weak job market, sticky inflation, and of course mounting pressure from the White House. Well, my colleague Josh Lipton tells us what else you need to watch this week.
Time now for what to watch in the market. Starting off on the Federal Reserve, all eyes, of course, will be on the Fed's September interest rate decision. The two-day FOMC meeting kicking off on Tuesday, and we'll also be getting a new summary of economic projections, also known as the Fed's dot plot. Wall Street largely expecting the Fed to cut rates at Wednesday's meeting. Fed Chair Jerome Powell will be giving a press conference after the interest rate decision. Yahoo Finance will be in coverage on Wednesday at 2 p.m. Eastern. And taking a look at earnings, we're going to be getting a new batch of reports from notable names, including Bullish Cracker Barrel and FedEx. Bullish announcing results for the second quarter and hosting its inaugural earnings call after the markets close on Wednesday. Analysts seeing a path for Bullish to take U.S. institutional market share from Coinbase, but only after new U.S. crypto rules are passed. Investors will be listening closely to the company's first earnings call for any clues about the company's path ahead. And moving over to housing, fresh housing data coming out on Wednesday with housing starts and building permits. Economists forecasting housing starts to fall to an annualized rate of 1.37 million, while building permits tick up slightly to 1.37 million.
Let's look at some of our top stories. I'm joined by Joachim Clement, research analyst at Panmure Liberum. Joachim, thanks so much for joining us on Market Sunrise. Let's start with the main event of this week, interest rates. What are you expecting on Wednesday? I'm guessing you're in the camp that is expecting a rate cut, but could we see more in 2025?
So I do think that we're going to see a rate cut, no surprise there. But I'm also very much in the camp that is consensus now, namely that it's just going to be a 25 basis point rate cut. And I expect another one in December. Having said that, the Trump administration is already pushing very hard for a so-called jumbo rate cut of 50 basis points. And Trump just reiterated that wish this morning.
Now, there's also the pressure we're getting on the Fed from the White House in terms of who ends up on the board. We could see Stephen Myron on the committee in time for this rate decision on Wednesday, but also he's trying to oust Lisa Cook. How worried does it make you as someone who watches the markets this closely about the independence of the Fed and what that potentially could mean?
That to me is the major worry, not just this year, but actually throughout 2026. How much more pressure will the White House put on the Federal Reserve? I think they will eventually be successful. And that means that I am, especially for 2026, expecting many more rate cuts than the economists' consensus number is at the moment. I think we will be below 3% at the end of 2026.
Now, moving on to our top story this morning, which was the news out of China on Nvidia, saying that they broke antitrust laws in an initial investigation. How's this all playing out? Has Jensen got this wrong for once?
I don't think so. I think China is using this threat of an antitrust investigation into Nvidia, and by the way, also into an anti-dumping investigation into other semiconductor companies in the US as a chip in the ongoing negotiations with the US about tariffs. Remember, we just are entering the second day of negotiations in Madrid, and kind of tightening the screws a little bit to get more concessions from the Americans. That's what I think is going on here.
And those trade negotiations, what are you hoping to hear from them when they conclude?
I don't think we're going to see a massive breakthrough on the tariffs overall. I think we're going to sort out the issue about TikTok and its ability to persist in the US. But I think there's much more negotiations needed and more rounds needed for the tariffs to be settled. And until then, we're going to delay the higher tariffs, just like we did over the last 180 days.
And over the weekend, we had some pretty significant news, I guess, out of France, with Fitch downgrading the country and its credit. The market seemed to have shrugged that off, though. What did you make of that downgrade?
Well, the markets are basically saying that Fitch is just catching up to where the markets already are. To give you an idea, 10-year French government bonds currently trade at the same yield as Italian government bond yields. And the Italian government is rated at a triple B, not an A plus with Fitch. If you want to take a comparison, Belgium has the same rating as France now, and Belgian bonds trade at 2.22% versus 2.48 for the French government bonds, so 26 basis points lower. So the market already trades French government bonds like they were triple B rated, not single A.
That's quite some downfall for the French economy there. Joachim Clement from Panmure Liberum, many thanks for your thoughts. Okay, we've got to head for a short break, but when we're back, we'll have some tips for how investors should play this widely expected Fed rate cut. Welcome back to Market Sunrise. So the markets are pretty convinced we'll get a Fed rate cut this Wednesday. But how should you position your portfolio as a result? Well, take a listen to our investor playbook. Julie Hyman spoke to Matt Powers from Powers Advisory Group.
We know the Fed's boxed in here. Jobless claims just hit their highest level since 21. Unemployment's creeping up. I mean, Powell basically told us a few weeks back at Jackson Hole that the focus is shifting to employment. So a quarter point cut next week is basically locked in. I think 50 basis points is off the table at this point, but I think it sets up for maybe a series of smaller cuts. I mean, they can't risk being behind the curve here if the labor market really starts to weaken even more from where we're at. So, yeah, there's one angle here and one thing to think about, that there's still over $6 trillion in money market funds. And actually over the past year, another trillion poured in. So it's been great when yields are 4+%, but we know that's going to stop. We know that, as the Fed cuts, those cash returns are going to come down. So where do we go? And that's kind of the question here. So, in a rate cutting cycle, we like dividend growers. They've consistently outperformed when the Fed starts to ease. To drill down a little bit further within there, we like REITs, we like utilities. REITs get this double down benefit from cheaper borrowing and rising property values. And then when you go to utilities, I mean, they're somewhat of a bond proxy, and they've got had it all year, really, that tailwind from powering AI data centers. And then small caps, I mean, they benefit mostly from lower financing costs. And, where we're looking specifically, Prologis on the REIT side. Mm-hmm. So it's a $100 billion market cap, the largest industrial REIT in the world. It should be a household name, but it's not. But it's a 4% yield, and they've grown their dividend double digits over the past decade. And you've got American Tower, which is the largest cell tower REIT that exists out there, over 200,000 towers. Same deal, great dividend grower, and it's 17% over the past decade.
Right. I mean, I was going to say, when you come to utilities, what's been so fascinating about the utility stories over the past couple of years is it's seen a tailwind from demand for AI, right? Because they need power. So we've seen a lot of outperformance there. Do you think they're then going to get that further juice from now the rate cut?
It's a great question. NextEra Energy is one we like. It's the largest regulated utility in Florida. They're the world's biggest wind and solar generator, and there's heavy capital investments involved in that, and borrowing costs just become lower, and so it certainly helps them. And it's back to that data center powering. They're a big player in that area, but we also saw some some of these renewable stocks rallied earlier because the rules weren't as restrictive as they feared on Trump's tax bill. But the outlook there is broadly positive, we feel like, on utilities.
Do you worry at all for a company like NEE that some of the wind rules in particular, we know this administration is very against wind power. Is that going to be a stumbling block for that company?
Yeah, potentially. I mean, it's going back to what I just mentioned. It's the rules are actually not as stringent as what was expected in that area. And ultimately with utilities, we do like the aspect of them being somewhat of a bond replacement or bond proxy. They're great dividend yielders, historically known for that. And when you see a pivot away from some of these money market funds and some of the rates, it's going to happen. It may not be this huge wall of cash. Going back to that money market idea is that, there's right now relative to the S&P, it's about 15%. So on an absolute basis, $6 trillion sounds enormous, but it's 20%, or it's about 15%. 20% is historically where money market funds are compared to the S&P. So not a big wall of cash pouring in, but people are going to start looking. We talk to clients about it all the time. They're going to start looking for higher yields, and utilities will play a part in that, certainly.
Now, Matt, if I'm one of your clients, I imagine some of them might be coming to you and saying, listen, AI has been working for me. Large cap tech's been working for me. Why mess with that, right? What would you tell them if they came to you and said that?
Yeah, great question. It's we know the Mag 7 carried the market first half of the year. This back half here, valuations, I don't want to say stretched, but we know that they're raised, they're inflated, whatever the word you want to use for that is. So where do we go from here? The reality is if you own index funds, if you own large cap growth funds, you have the mega caps inside their period, whether or not you like it. So they're basically, it's unavoidable. It's an unavoidable area of the market. They'll remain core holdings, but they really can't be the only drivers from here. The next leg higher has to broaden out. And so that kind of leads into somewhat of a market broadening theme, I think, that we're starting to see.
Time for another short break, but stick with us as we'll have trending tickers, which is going to include some breaking news on Tesla when we're back. Well, our first ticker today is Tesla. The stock is up big time today. Shares rising more than 6%, powered by a surprise move from Elon Musk. Musk disclosed that he bought roughly 2.57 million new shares worth about $1 billion through a trust over the weekend. This boosts his direct holdings, excluding options, to around 413 million shares. Investors are reading into this as a strong vote of confidence, especially as Tesla has been under pressure from slowing demand, competitive headwinds, and concerns about profit margins. The move also comes as Tesla rallies towards an 8-month high. So that's Tesla, a big jump today after Musk's big purchase reinforced those thoughts. Okay, moving on, our second trending ticker is PopMart. And they're the maker of the viral Labubu dolls, and it's losing steam. And it's no child's play for traders either, who are losing big on the stock this morning. PopMart shares dropped nearly 9% in early trade today in Hong Kong, before paring some of those losses ending down around 6%. That means PopMart has lost roughly $13 billion, about a quarter of its market value since its peak at the end of August. Though it's still up over 180% year to date. Well, what's behind the drop? Well, analysts led by JP Morgan downgraded the stock to neutral and cut its target price by around 25%, saying that the resonance of the Labubu charm is fading. Demand is cooling, resale prices are falling, and production costs, well, they're on the rise. PopMart has been diversifying and launched other newer toy lines that have done reasonably well but haven't come close to matching the Labubu pop culture buzz. And finally, Opendoor is standing out again this morning in pre-market. We keep seeing big swings here. Shares are up around 6% now after closing down just under 14% on Friday. But overall, shares of the real estate platform have been rallying on leadership changes in the past few days. Opendoor shares are up by more than 1,400% in 3 months. And a lot of that growth has been fueled by social media chatter and meme stock momentum. But now that co-founders Keith Rabois and Eric Vu just rejoined the board and former COO Kaz Najatian becomes CEO, there are some fundamental changes ahead. The stock tumbled on Friday after co-founder Keith Rabois made public comments calling the company bloated. He said the workforce of 1,400 is far more than needed, that the company needs to cut 85% of its workforce, and remote working culture had broken internal systems. So what's next for Opendoor under this new leadership team? Eric Jackson, founder of EMJ Capital, spoke to Josh Lipton about what he expects from the new leadership.
Keith Rabois has been the most outspoken guy on Twitter, like up to this point, out of any of them, in terms of sharing his thoughts. He never holds back. Like he has no filter. Just like what he thinks he says. You know, he's very was very critical of Carrie, the former CEO. Said she was like Scully. You know, and needed to be gone as ASAP. He was right, by the way. And so I tend to think my personal belief is like he's the smartest guy in tech, in bar none. Okay, I agree with Keith. He's not always 100% right. None of us is, but you know, he tends to be very, very right and very on the money and knows how to create value. So he's already hinted like there needs to be major job cuts here. There needs to be like a focus on AI. There needs to be an explosion of the number of sellers and buyers like on Opendoor transacting. And this can be the Amazon of housing if they get this right. Now it's been kind of validated, that view, because obviously he's back on the board now. He had a major hand in hiring Kaz, the new CEO. Keith thinks that Kaz is going to be like the Travis Kalanick in terms of how he goes about this. There's apparently been a big like work from home ethos at Opendoor. That's gone. You know, everybody's going to be in the office now. Keith said this company could survive with like 10% of the current workforce, and the rest done through AI. Like that.
How big is that workforce right now?
1,407 people currently, according to Bloomberg. So he's talking about going down to like 100-person, 150-person workforce. Probably, you know, so it would be a major difference. So the bearish case against Opendoor before Keith announced the 80% update yesterday, and Keith and Kaz coming back was like, iBuying's never worked, therefore it will never work. And this company has failed before. It's a little dinky company, $3 billion market cap or whatever. Like why, it won't be successful. So mind you, like that argument would have said that when Steve Jobs came back to Apple, just shut it down then. Like there's no point in continuing because it hasn't been successful to this point.
Which some did say, by the way.
Michael Dell did say that.
Yep.
So anyway, but then you say, like, why would the number 2 guy at Shopify, who probably, if he played his cards right, would be the CEO relatively soon, widely respected in the world of tech, everyone loves him. Why do we leave Shopify and take the job as CEO of a I don't know, before the 80% update was probably a $2 billion, market cap company. Like, obviously, like, he sees the same vision that Keith does, and he thinks that this can be the Amazon of housing. First in the US, but then, like, the Uber playbook is you blow that out worldwide, international. So, like, obviously he sees this as a big opportunity, and I agree with him.
Well, we're going to look briefly at 3 market movers this morning. Let's start with gold. Gold has been holding steady today with futures trading near $3,680 an ounce ahead of the Fed's expected rate decision later this week. The metal recently hit a string of fresh record highs before easing on profit taking and a slightly stronger US dollar. Remember, Morgan Stanley sees gold hitting $3,800 and we're seeing other bullish calls. But watch the Fed closely this week to see where things go from here. On to oil now, and oil prices extended modest gains today, supported by drone attacks on key Russian energy infrastructure, for example, the Kirishi refinery, raising concerns about potential supply disruptions. Brent crude is trading up around $67 a barrel, while US West Texas Intermediate sits near $63. Meanwhile, despite these driver events, there are also growing concerns about oversupply from OPEC Plus output increases. And last but not least, Meta is in the spotlight this week. The stock is now down slightly in pre-market as investors shift their attention towards Meta Connect 2025. It's actually up very slightly as investors shift their attention towards Meta Connect 2025 on September 17th. What's expected? A major push into AI-enabled smart glasses, rumored to be named Celeste or Hypernova. Updates to the Ray-Ban Meta lineup, enhancements to Horizon Worlds, and developer tools for immersive metaverse experiences. The big question is, how will investors trade Meta today and the rest of this week? All right, let's get a final check on the markets before we go. And global shares traded steadily near record highs today at the start of what is definitely going to be an action-packed week. Let's start in Asia. And as you can see, it's a sea of green there. Remember, the Bank of Japan is also expected to make a rate decision this week, and they're expected to keep rates on hold. The positive mood in the region, though, is being driven by the expectations of a Fed cut this week. Tech shares in China performed well today and seem to shrug off news about the economy. Let's move on to Europe. And don't forget, on Thursday, the Bank of England will release its rate decision. Again, rates are likely to be kept on hold. French shares seem to have shrugged off that credit rating downgrade by Fitch. And finally, a quick look at US futures, and they are sort of struggling a little bit there for direction. In the US there, not far up the flat line, obviously waiting on the Fed. And that is all we have time for Market Sunrise this morning. Stay tuned for more on Yahoo Finance. I'm Ramzan Karmali. Go own the morning.